Hello?
I don't want background music. Get rid of it.
What?
I don't want the background music.
Gone. See?
Thank you. I'm trying to figure out what's going on with my screen there. I'm like, what happened?
I can see your screen.
I know. I was trying to figure out why I had music playing on my screen.
I messed with you. I like it.
Yes, you did. See, because you threw me all off there. Now I have to do this and come back to my. Oh, now I remember. Never mind. I'll be up and running in a second. There we go. So you can just see the.
Yes. Just a slide. Yep.
Which is bopping through without my.
Correct.
No, I'm just trying to fix that. Okay, perfect. 4:30, just about right on time. So I'll give it like another 30 seconds and then we will start up just to make sure that we keep everything moving on time with these. And this one's got a fair amount of slides, so I don't want to spend too much time waiting for people to jump in, but I'll give it about another 10 seconds or so and then we can start right up. Okay, so thanks for joining us. This is our weekly webinar series that we call Thirsty for Knowledge Thursdays. It's brought to you by the Aries Foundation for Financial Education. Just to make sure that you have boarded the right flight this evening, this is 9 IRA mistakes that could ultimately cost you a fortune. And we'll talk about a little bit about how that all works and what each one is involved. But before I do that, I do have a pre-flight checklist that I do like to go through. We like to keep everybody muted. Your cameras are off, but it really doesn't matter because that's not what's recording. Only the PowerPoint presentation is actually being recorded. However, we do ask that if you do have questions that you do utilize the chat box to ask those questions. There will be a Q&A at the end. My co-pilot who's on the line with me is going to make sure and just keep checking the chat box to make sure that any questions do get answered as we go along, and also to keep me on pace because he knows I drone on sometimes. So your pilots for tonight's flight, I am Tom Alessi. I'm the president of the Aries Foundation for Financial Education. I have been in financial services for more than 20 years. I am an investment advisor, which means that I carry and have to act as a fiduciary when dealing with my clients. My co-pilot for this evening is Craig. Craig, bring yourself on and introduce yourself.
Sure. So I'm Craig Richardson, Vice President of Aries. I've been in the financial services field for 16 years, and I specialize in helping families and small businesses to put together financial plans.
Certainly appreciate that. And Craig will be joining in as we go along through this evening. As we said, that this is brought to you by the Aries Foundation for Financial Education, Inc. You can visit our website at ariesfoundation.org. The Aries Foundation, our goal is to try to help everyone have a better relationship with their money. Our mission is we believe that financial wellness is a contact sport. There needs to be guidance and encouragement to go along with the tools and the software and the websites. Otherwise, engagement just does not happen. And without that connection, without that without that encouragement, participation just falls off. So that's our mantra. That's what we try to do, is get everybody involved, get people engaged. And you can visit the site and learn a little bit more how we do that and the programs that are involved. Few disclosures here before I begin. So these presentations are meant to be purely educational. You know, we mean that literally, that we make these available on the website. We share them on our YouTube channel. We ask that if you are going to share them, that you do the same, that you use them for educational purposes only. The Aries Foundation for Financial Education, Inc. is a nonprofit and is not affiliated with any broker-dealer or securities-related business and is not a registered investment advisor. Aries Foundation strongly recommends to everyone, Greg and I bring this up all the time, that if you've got questions, whether they are legal, tax, or investment related, that you seek out the help of a professional to help with those questions and to get the answers. And the last bit of fun before we start up with the presentation, there are beverages on this flight. We do call this Think with a Drink for a reason. Part of it is that we take the information we try to convey and give to everybody very, very seriously. We just don't take ourselves too seriously. And so we want everybody to be relaxed and enjoy the time that you're spending with us here. And so we recommend pouring yourself a cold one. If you don't imbibe or choose not to, hopefully you can find something refreshing to pour along with us. In the case this evening, I am pouring one of my happy places on the planet, which is Jack's Abbey, their Copper Legend, which is their Oktoberfest, which is very malty and smooth. And this year happens to come in 16-ounce cans. Finally, thank you, Jack's Abbey. Craig, what are you drinking tonight?
Actually, I am going back to Vermont, and because it's the fall, and going with Woodchuck Amber Cider.
An amber cider.
Yes.
That's an interesting mix there, amber cider. Very nice.
Yeah.
I was at a place that had cider donut cider and some whiskey barrel stuff that was quite impressive, but you know, it wasn't really all that drinkable. Anyway, moving on. So 9 IRA mistakes that can cost you a fortune.
Are you still in golf mode? I thought you said 9 iron.
Yeah. Still thinking about golf, right? All right. So let's go through, you know, why IRAs are valuable, right? Why they're good and what they really mean for everybody. You know, it's that you can transfer money to and from retirement plans on a tax-free basis. You, not your employer, are the protected and listed as the owner, right? So the IRA remains individual retirement account. It's in your name. It's not in your employer or have anything to do with them. It's an umbrella term. You can pretty much hold just about anything in an IRA. It says wide variety of products and custodians. You know, you can even hold real estate. Just don't ask Craig and I about that, because believe me, I've been through the headache of trying to help clients figure out whether or not what kind of real estate you can put into an IRA and hold with it. And there's a lot involved and gets really messy. But it defers your taxes. You don't pay taxes on the money that goes in, and you don't pay taxes until you withdraw it out. These are all very, very good things and why IRAs are very important. But they're not without danger, right? And so some of the things we're going to talk about here are these 9 mistakes that we see over time and some of the steps that you can take to try to avoid that and alert you to some of the situations that can occur, whether that's for you in the near to distant future or for somebody that you know who's already dealing with that, right? So the idea with this is keep your nest egg safe. That's your money, and protect it how you need to protect it, but also maximize the amount of money that's going to your beneficiary. All right, mistake number 1, right? This is not understanding when you must begin taking your required minimum distribution, okay? So we're in 2020 now, and Craig and I, for most of this presentation, are only going to be talking to you about what's occurring during 2020, the sandbox that we're in today. There are a couple slides we'll deviate from that, but for the most part, so we're dealing with what are now new rules for RMDs, right? So before 2019 and previously, your first required minimum distribution was required at age 70 and a half. That has now changed thanks to the Setting Every Community Up for Retirement Enhancement Act otherwise known as secure, the Secure Act has changed required minimum distributions to age 72. Unless you turned 70 and a half in 2019, going into 2020, it's 72 for everybody. So that's when your first distribution now has to occur, is at age 72, right? And that's known as, required minimum distributions. In our world, for Craig and I, those are RMDs. But what happens if you don't take it, right? So what happens is you get hit with a 50% penalty. That's every year that you don't take that required minimum distribution. They're going to hit you with a 50% penalty. If the average, Craig, what would you say the average RMD out there is? Probably somewhere between like 7,000 and 10,000 on an annual basis.
Yeah, probably somewhere between 7 and 10. Yep.
Right. So I was going to take a drink of booze. You answered too quickly there.
Oh, sorry. So that would mean your tax, your 50% withdrawal excise tax would be half of that. So only between $3,500 and $5,000 you pay as a penalty
every year that you miss it. So that's 35 to 5,000 in a tax penalty over and above that. You have to take the distribution on top of that. Right. So that's one of those things that we're always talking to people about, that you need to really take. Again, RMD stands for required minimum distribution. When must they be taken? The first one now, thanks to the Secure Act, is at age 72, right? And then you've got to take it every year after that by December 31st. They don't care when you take it during the year. They don't care how you take it during the year. You just have to take it all. That whole distribution has to come out by December 31st. Realize, go ahead.
I'm going to say, except for this year, right?
Right. Well, again, we're in a pandemic here, so we're sort of playing that we're not dealing with this. They pushed the required minimum distribution for this year, but that's fingers crossed, not going to apply next year, and we're going to be going forward with that. But
yeah, I just want to confuse anybody if they thought they had to start taking it this year because they turned 72. That's all.
Right. That is correct. You don't have to do it. So mistake number 2, right, is not knowing how to figure your required minimum distribution. And this gets involved. There's math and there's things there. Now, most of the time, you can just ask the custodian, whoever the institution is that has the IRA, to calculate it for you. You can do it yourself. The IRS puts out these tables, and for the audience that we're dealing with here, we're just going to pretend that everybody is married to somebody who's within 10 years of their age or is a single filer. You will use the uniform lifetime table for that, and I'll get into that in a little bit and go through the table with you. Otherwise, you have to use a different table. But for most people, they fall under the uniform lifetime table with it. And so basically what you do is you use that table, you take the value of the account on 12/31 of the year previous. So in the case of the 2020 distribution, you'd go to 12/31/2019. What was the value of the account? And that's what I'm going to use to calculate my RMD. And it's recalculated annually because you just keep going through it, and I'll explain that in a second when I get to it. This thing with the variable annuities, I'm not really sure. I think that's specific to contract. Craig, I don't know if you had any information on that. It's not something I'm aware of, that there were different rules that apply.
Well, the issue is, sometimes the annuities themselves have rules that are opposed to the RMD or in conflict with. And so what happens is the annuity companies will generally honor whatever the RMD request is, regardless of the rules in the annuity contract.
Oh, so you're saying if there's like a surrender charge or something like that comes in.
It's waived in order to make the RMD.
Okay, I understand what they're saying with that. Yeah, I was a little thrown with it in terms of going through it with that and figuring it out. So the way that table works is it just says, and I left this one in place because the uniform table, even going forward, will still have 70 listed. Probably you'll see that change happen in a couple of years where they'll change the uniform table to be 72. But the reason I bring it up is because right now this is the table that we're dealing with. The IRS is making a proposal. There is pending legislation to change the tables for next year for 2021, but nothing has been formalized yet. But if you just did it out and you said, hey, I've got $100,000, if I was 70 and I was taking that calculation, based on how that works, what would it look like? So I'd have to take $100,000, I'd divide it by 27.4, which would get me 3649. That would be my RMD. If I jumped ahead to the next year, right, I recalculate. Again, if I still had $100,000 on 12/31 of the prior year, I then have to take it and say I've got to divide that number by 26.5, and I get 3773. If it was 72, you would see that number is 25.6. So 100,000 at 20 divided by 25.6 is 3905. And you can see what's happening is that while the government said, hey, we're going to push this off until age 72 to allow for distributions to occur, what they're doing is if there's more growth in the account, that's more money that's going to come out in taxes, one. Two, the tables that they are pending and trying to update will have bigger numbers. So you're going to have to take more money out if these new tables go through. The government's never going to let you get away with anything.
Well, the other question, Tom, too, is if you look at the rate there, at $100,000, you're taking out 3.7%. What's the likelihood based on, the Monte Carlo analysis that you're going to run out of money pulling out at those rates?
Correct. That's what really is going to happen. I mean, the government wants you to drain it. And it's going to keep going up. It's not even a straight 3.7.
Mm-hmm.
Right? It's 3.9, then it's 4.1, then it's 4.4, then it's 4.7, and so on down the line, where they want their tax money. They want you to drain that account out. That money is not meant to stay there for the rest of your life. That's the whole point.
So if you did a straight line without a lot of growth because you're fairly conservative, likelihood you'd be done with that IRA by 85, 90 years old, basically life expectancy.
Right. Somewhere in that, exactly. Life expectancy, somewhere around 87, 86 years old. Exactly. As far as the distribution is. That's why it's set up that way, to go through that. So mistake number 3, right? We're staying on the required minimum distributions, and this is taking it from the wrong account. And not that there's a right or wrong in terms of this, but what happens is what you can do is if you've got multiple IRAs, you can take the IRA, you can take the distribution from each one of them or from one of them, but with the whole pool added together. So in this case, you've got $500,000 spread out over 3 IRAs. If you were 72, you would take $500,000 divided by 25.6, whatever that number comes out to, and you could take it from IRA number 1 or IRA number 2 or IRA number 3. You have that choice. You can take it from each one of them if you want to, but in some cases you might have accounts that have better rates or getting more interest or is in a position that you didn't want to take a distribution from. So that's why the idea and the benefit is I can take it from one and not the other and let the other one, maybe the other suffered some downside and I want it to recover. Right? So you can take it from any or all of them. The problem is if you have IRAs and retirement plans from the employer still, in this case, it shows 401ks, 403bs, profit sharings, these are all the different type of plans out there. And there's money in each of these buckets. You've got to take it from each one of those respectively. You can't commingle the total and say, oh, gee, my total distribution for this year was $10,000. I took it out of my IRA. I'm all set. No, the IRS is going to say you owed a distribution from each one of these accounts, and we're going to hit you with a 50% penalty on each one of those other accounts because you didn't take the money out of it. You got to be very, very careful about how you're doing those distributions as it's spread out over time. And that's one of the biggest things with this is to make sure, and that's why Craig and I, we talk to people all the time about looking at consolidation of accounts. It's much easier to manage that way, much easier to figure it out, much easier to deal with. A lot of times institution, the custodian will automatically do it for you. but sometimes you have to fill out paperwork and make that request of them. And if you don't do that, they're not obligated in any way, shape, or form to send you money if you haven't told them to do it. So a lot of that is on the individual to make sure that they do it.
Is that ever audited, Tom?
So that's, yes, right? It's supposed to be, right? So there's the thing. So failure to withdraw it, this is where it comes up, right? Where it's that 50% penalty. One of the things that really the IRS specifically has been talking about for the last couple of years now, where, with everything going on, and, what are we at now in terms of $1 trillion in debt, right? With the whole stimulus package and anything. Well, where are we going to get that money from? They're going to get it from Nana. But Nana forgot to take her distribution out. So we're going to go get her 50% from her because she forgot to do it. They've sort of let it go for a while, but now there's been much more focus and impetus on making sure that if money is not being taken out of these accounts and it's not being taken properly, we're going to get our piece. Absolutely.
Well, it's not enough we're stealing the cookies out of our cookie jar. Now we're going to take the money out of their IRA as well.
Yeah, that's the thing. And we're going to hit you with taxes, and then we're going to take the money out on top of that, right? That's another part of it. So mistake number 4, right? Taxes or everything. This is a little different in terms of when we talk about the 20% tax trap, okay? So talking about a tax trap here, when you take money out of an IRA, right? Because we're talking about tax-free rollovers now, right? So if you take money out of an IRA, typically, and in most cases, you can tell the IRA not to withhold any taxes, right? You're going to pay them later, or maybe you've got some losses, whatever the case may be. Now, what we're talking about is going from one IRA to another, where I've taken money out and I've got 60 days to then decide, oh, hey, you know what? I didn't want that money after all. I'm going to put it in my other IRA, or I'm going to open an IRA at another institution or with another custodian. So I can do that. I can take money out. Government only allows it once. You can only do it once per account per year now. Before it used to be unregulated. You could do it as often as you wanted. But I can go like to like. See, that says regular and Roth, or what I call traditional IRAs. So I can go traditional IRA, Roth IRA to Roth IRA. Just understand that. If you try to cross the path, go traditional to Roth, that's a taxable event. But I can take money out of one IRA, not have taxes withheld, and then so long as I take it within 60 days, put it into another IRA, it's not taxable. If I try to do that with my employer-sponsored retirement plan, they are mandated to withhold 20%. I don't care if you're only in a 10% tax bracket. They're going to withhold 20% from your distribution in that case. You can then try to put it into an IRA, but you're going to be 20% less. So the reality is, what you really need to do is to do this where it's in a what's known as trustee to trustee transfer, going from institution to institution. I'm sending the money from one institution to another institution. That way, I'm out of the picture. And there's no withholding, there's no taxable event in that case. Craig, you can sort of chime in with this. With a lot of times, some of these plan trustees, they're actually sending the check to the individual's home.
Yeah, it's dependent on the institution. They're all different. Some will send it direct, based on, you call them up and based on their client asking verbally. Some of them want their own forms to get money distributed and to where. Some of them will let you direct it to the other trustee, and some of it will make them send it, payable to the employee. So it's all over the place. There's no just general rule.
Right. Right.
The other thing to keep in mind,
even if it's sent, and the whole idea with this, as Craig was sort of talking about, is that, so even if it goes to your home, the way it is made up is it's made up payable to the institution. So if you're trying to transfer from your employer plan to an IRA at institution 123, the check is made out to institution 123, what is FBO, for the benefit of you, the individual. Even if the check comes to your house, the only place you can put it is in that account at institution 123. You can't go to the bank with it. You can't cash it. There's nothing you can do with it. So that's why it protects it from being taxable, because it can only go to that institution. If you ever get the check when you're trying to do that and it's made out to you in person, send it back. Don't do it, because then that's going to create that taxable account, that taxable event.
And something to keep in mind too is even if you do get taxed at 20%, what they have to mandatorily hold it. If you don't owe that much in taxes at the end of the year, if you're in a 10% tax bracket, then you're going to get that portion back.
Right, but it's not going to go into your tax. It's not now sitting
Not
in
gonna stay in
your
your
retirement account and growing. And
qualified
right.
cash. Right. Yep.
Yeah, that's the issue with that.
Well, I'm just saying it's not a penalty they're paying in addition. It's just a standard deduction at that point. Just like you pay out of your paycheck, you may get some money back at the end of the year if you overpay.
Well, right, but depending on the amount, you could be pushed into a higher tax bracket, in which case you're not getting that money back. Right? I've now gone from a 10% tax bracket into the 20% tax bracket. They withheld 20%. I'm not getting that money back.
That's right. That's right. Hey,
So
I'm going to stop my video for 1 second just because I've got a hardwire. I'm breaking up. I don't know if you could tell.
okay.
I'll be right back.
If you freak out on us, that's okay. I'm going to keep powering through. I appreciate it. All right. So mistake number 5, not structuring your IRA to allow beneficiaries to stretch your IRA. Again, we're in a new world here. Old world, you used to be able to put a beneficiary on, younger individual who did not have to take the full distribution. They could take it based out over their lifetime. That's gone. Thanks to the setting every community up for retirement, the Secure Act. That is now, it's out the window. The only way you can stretch now is 10 years. We're dealing with non-spousal beneficiaries. So non-spousal beneficiary, you pass away this year, they have to start taking those distributions by 12/31 of next year, right? If it's not properly structured, that there are some cases where it has to come out within a 5-year time period. Most of the time now, thanks to Secure Act, that distribution will occur over 10 years. So you've got 10 years now to take the funds out, whereas before you used to have lifetime. So that doesn't exist anymore, but you still want to make sure that it's set up in a way that, hey, I can get these funds out where I don't have to. IRA, for most cases, it's 10 years. Where that gets a little bit, funny with this, I mean, the beneficiary can always take the money out as quickly as they want. They always have access to the funds, right? But what are the reasons that you stretch it? One, if you take it all out in a lump sum, as we just sort of talked about and walked through a little bit, you create this large tax event that's going to occur and could push you into a higher tax bracket, which means you're paying more money in taxes than you necessarily should. But also, if the money's sitting in an IRA, it's protected from creditors. They cannot touch your retirement account. So it's another reason to leave it there and let the stretch occur. Now, one of the things with this, with the new rules to a stretch IRA, whereas you have 10 years, that 10 years is actually not, hey, I have to take 10% out every year. I just have to have it all distributed out by the 10th year. So I can leave it in there for 9 years and then take all the money out. Granted, I'm in a, that's that whole lump sum tax thing occurring, but I can do it. I don't have to take the money out if I don't want to. I just have to have the whole account distributed within 10 years.
Hey, Tom, is that also protected from, let's say, the first spouse is in a long-term care facility and all the money was they had money in an IRA. Second spouse left it in the original IRA. Would it be subject to them coming after that money?
Just make sure I follow the question. I'm spouse A. Spouse B is in the nursing home. Spouse A is the IRA. It's in my name.
No, spouse B has the IRA.
No, not protected.
Not protected in that case. They're considered, so they jump over that.
Correct.
They see the creditor. Okay.
Yeah. That's, again, that's not a creditor. That's the government, right? That's Medicaid wants that money. That's what that is.
Oh, right. Okay. So if you're on Medicaid, then there's a
'Cause
clawback.
if you're in a nursing home, they're going to look at whatever you have for assets, and they count that as an asset.
Okay, so that'd be like a clawback provision type deal. Okay, so you're not protected from the government. So
Yeah.
back taxes, all that stuff, right? Okay, gotcha.
Yeah. So this just talks about the creditor protection, right? That basically that if money's sitting in the IRA, it's pretty much you're not going to be able to get at it. For beneficiary purposes, we always talk about making sure that accounts have beneficiaries. We talk to people all the time about making sure going back in and looking at all of the accounts that can have a beneficiary. In this case, we're talking about IRAs and employer-sponsored plans. Now, most of us will name, if we're married, we have to name our spouse. Well, you don't have to, but God bless if you tried to go home and have your spouse and say, oh, honey, I'm going to name somebody else. Yeah, that's never going to work well. But
Well,
then,
huh? So you know where that does come into play, though, and I've had that come into play when I'm dealing with people who are in a second marriage.
Right. So you're dealing with that. But so in this case, right, primary beneficiary, spouse. Then you name the kids as contingent beneficiaries. And then this talks about tertiary beneficiaries, which we are then making sure that someone is on the account should I pass to protect the account, right? This is per stirpes, which just means bloodline all the way down. So somebody is going to be on and available for the account.
That Latin just keeps coming back up, doesn't it?
Yeah. Right. However, the issue is the money that's in a retirement plan, in an employer-sponsored retirement plan, has to come out quicker. You don't have the same rules apply for money that's in a 401k, right? Especially when it's non-spousal. It's just dealing with it it's usually a 5-year window for that the money has to come out from your qualified plan, right? In some cases, it doesn't see it that much anymore, but in some cases, what you do see is that some employer plans will only allow a lump sum distribution to a beneficiary. Most plans nowadays, they've mandated and changed everything, that it's a 5-year at maximum withdrawal that you can do. But there are still some out there that do have that lump sum only.
But you're only talking about non-spousal, right?
Correct. That's non-spousal. We'll get into the spouse in a minute here in terms of dealing with that, right? So this just talks about not taking advantage of some specific lump sum rules. And I don't want to spend too much time on it because it's really about employer stock. That's usually where we see this, right? Is that you've got a situation where you've been either had the ability to purchase or buy stock inside the retirement plan. Now, a lot of this has changed in terms of companies doing this too much, thanks to Enron and some of these other companies that went bust with that. But they're still out there because it's still available and it still can be done. And if you believe in the company, that it's certainly a very good thing. But suppose your IRA has $500,000 of company stock in it, but your basis in that position was only 50,000, right? Which means that you've had considerable growth over a period of time, but it's in an IRA, which means you've got $500,000 really of taxable income to you. And so what can you do to try to get that out without running into it? And the wrong way is to just, once you leave the company or turn 59 and a half, you just take all the money out and guess what? You're getting hit with taxes, or you pass away, your heirs, your beneficiaries, they're paying ordinary income tax on everything. When the right way to do it really is to take the stock itself. You will pay for the basis, that 50,000 of basis in the stock. That's what it costs your purchase of it. That's what you're getting taxed on. And then when you need to, at time, you sell the stock later and it's capital gains. Capital gains right now, 20%, right, Craig?
Well, it depends on the income, your income, but yes, the top tier is 20%. It used to be 15.
Yeah.
But so this works whether it's in the IRA or not, correct? Because I know I have some clients who actually get stock as a bonus, but it's not included in their IRA.
Right. So this is more talking about when it's in the IRA because you're trying to avoid that tax hit.
So why so we all know, why is it you can use the long-term gain tax inside an IRA when it's a company stock, but not when it's in regular investments?
Because what you did was you took the IRA and you paid the taxes on the basis of the stock at the time you separated.
So you almost turned it into like a Roth.
Well, in a way, but what happens is just the basis is taxed. I haven't sold the stock. I just took the IRA and transferred in kind. So I still have $500,000 in company stock.
So technically that money, once you do that, would no longer be in a qualified plan, right?
Correct.
It's qualified plan rules.
Correct. You've now moved it to a non-qualified, and just for those in the audience, non-qualified just means after-tax account. So we take it, we move it to an after-tax account. I pay taxes on the $50,000 of basis. And then I've got $500,000 in company stock. When I sell the stock now, it's all at capital gains. I'm not paying ordinary income tax now. And the way that looks, just to follow through with that, right? Same thing with the heirs. It's just based on what's there, right? So if you did it the wrong way, you got hit with, you say 35, you probably, that's a marginal tax probably. It might be a little bit less. It doesn't include any state tax in that, right? But the right way is you're only paying it based on the 50,000, right? And then you're paying, that's 15%. That's what we talked about that with the income in terms of going through it. But you can see the difference, what gets made up there. And this happens with a lot of situations that we run into where people just walk into suddenly, getting hit with a tax bill that's hundreds of thousands of dollars that they could have avoided, right? So now this talks, Craig, this is what you're asking about where before it was non-spousal, now we're dealing with spousal IRA, right? Right. So we're dealing with a spouse, and you can simply just as a spouse, you can continue the plan as is, right? And roll it to an inherited IRA. So it's client, it's the FBO of Sue, she's now the owner, because you cannot, you have the ability at that point to just transfer, right, into her own IRA. But it can't be rolled. It can be transferred, it cannot be rolled over. We'll talk about that in a second in terms of the difference there. But the spousal inherited IRA, right? So you can do the same thing. I can move it to my retirement account. I can make my own IRA with it, right? As far as going through that, you have the ability to do any of the things in terms of combining them for any way that you want to. But why would you not execute that spousal rollover, right? Now, here's the thing. I told you earlier that everything we do and are talking about are in today's world, today's sandbox, right? As far as that. This is the one area where we're not talking about today's sandbox. Because the federal estate tax right now, the limit, the threshold, is 11.5 million per person, or 23 something for a couple. Now, that sunsets in 2025. So unless you're planning on dying in the next 5 years, you fall under that 11.5 million threshold. But after 2025, once we get into 2026, they're going to reset the rules. And we don't know where they're going. Now, in 2009, it was at 3.5 million. That seems to be about what they're talking or thinking about. They might roll back to. At least right now, that's the talk and what's out there in terms of it. Craig, I don't know if you've heard anything else in terms of that.
No, I have not. Like I said, this has been a bouncing ball for as long as I've been in business. I mean, I remember back in 2008, 2009, there was no federal estate tax for like a year or two.
Right. That's a George Steinbrenner thing. For anybody out there in terms of the audience, the owner of the New York Yankees, worth like $1 billion, died in the year they reset the estate tax to zero. So the Yankees owed no estate taxes on that whole estate. But no, what happens is, if you don't do it, then it goes into the spousal estate, right, and becomes a taxable event in that situation. Which creates a larger tax burden on the survivors in that situation. Whereas if you don't do it, you don't have that situation occur, and there's no estate tax. There's no estate tax to it. We'll get into the estate tax thing in a second, because that's a different animal in terms of going through that. So Roths, I think, are one of the most misunderstood vehicles that we have available. Roth is after-tax money. You put the money in, it's after tax. You get no tax break for it, but it grows tax-free. So when you take the money out, you do not owe any taxes at that time, right? And so you have the ability to create this tax-free income because you don't have to pay taxes on the money that comes out, right? Qualified distribution, the money's got to be in there for 5 years. Basically, you've got to be 59 and a half when it happens, right? 59 or older, and I love this part. You're totally disabled or dead, right? That's in terms of taking the money out. Right? That becomes the qualified distribution on a Roth, which means the government says, okay, you can take it out, there's no taxes.
Right. That only applies to the interest you earned, not your basis, because you've already paid taxes on the basis.
Correct.
So there is no penalty on any of that money if you pull it out before 59 and a half, only on the interest.
Right, but they're going to take it out in a basis, in a tax first.
Right. Oh yeah, absolutely. Yep.
That's why you wait until 59 and a half, because otherwise anything you're taking out is going to get taxed.
Correct.
And penalized, by the way, under 59 and a half. You have the same IRA rules where you get hit with a 10% penalty.
Because they do just like an annuity interest first. Yep.
Right.
Mm-hmm.
As far as going through that.
Basis
Right.
left.
There's never really pre-tax. That's the basis part that Craig was just talking about, but it's the gain in the account. So the pre-tax money, it's not pre-tax money, it's after-tax money. It's never taxed again. And then so long as it's qualified, like we just talked about, there's no taxable event that occurs. But you're not held to any of these required minimum distributions. You don't have to take the money out. Your spouse doesn't have to take the money out. The beneficiaries don't have to take the money out, really. I mean, there's some limitations there, but for the most part, they don't really have to do anything with the account. Two ways to create a Roth, right? You can just put money in 2020, that amount is $6,000, and you get $1,000 for what I like to call the catch-up provision. That's the Heinz 57 rule, which just says that I'm over 50 or turning 50 in this year, I can put an additional 1,000 in to make a $7,000. There's no age limit for contributions. It doesn't matter if you're participating in a retirement plan. There are limitations on who can contribute based on whether you're a single and you earn 124,000. It then ratchets down over the next 15,000. If you make more than 140,000, you cannot contribute. If you're married filing jointly, that number is 196,000. If you make more than 206,000, you cannot contribute to a Roth. However, you can take your current IRA, 401k, 403b plan and convert it to a Roth. And in that case, there is no limitation. There's no AGI, there's no looking at it from a point, and partly because the government wants their tax money. But the flip side of that is looking at it from a tax planning into the future point of view. I might be at a certain limit or bracket in my taxes. And if I'm in that 12% tax bracket, maybe I can take another 2,000 and stay in that bracket. So maybe I'll take 2,000 out of my IRA or my 401k plan. I'm only going to pay 12% on it, And now I've got money that's never going to get taxed again because I converted it to a Roth. And this goes back to the conversation with those stretch plans, ways of trying to lower or limit the amount of tax that's done. It's a fundamental view of how you're looking at the money that's coming out. The problem is for most people, and Craig, you can certainly chime in on this, most people, the money is all being put into a 401k, 403b plan, the retirement plan, which is great. It's good that you have it. The problem is when you go to take it out, it's all taxable.
Correct. Correct. Yeah, I've seen a lot of people who've done that, especially some older people who got into the 401ks when they first started in the 80s and thought they were the greatest thing since sliced bread because they were advertising as, lower your taxes, don't pay any taxes now. And the promise was that when you retire, you're going to be in a lower tax bracket. So you're going to pay less taxes overall. The problem ended up being is that people were spending almost as much money in retirement as they were spending before they retired. One, because they're living longer, and two, because they're healthier, able to do more. So they're on the longest vacation they're ever going to take. So that ends up not being the case. And so all those people who didn't have, we call a strategy of, like, I know you like buckets, of having money spread across different buckets with different tax consequences. You basically, every time you take a dollar out, you're giving 30 cents to the government. So it really puts you in a cash-strapped situation in that regard.
Yeah, and it affects other things. We talked about this before, and we'll come back again in a couple of weeks with it in terms of that penalty and what happens there in retirement, because that can create a tax on your Social Security. It can create a Medicare premium surcharge, all sorts of things that can occur. Like, that whole myth of you're going to pay less in taxes is just that. It's a myth. You end up paying more because it affects every other benefit that you're getting.
Well, the other thing I see too, Tom, and this is another good reason for the Roth conversion you're talking about, is you are stuck taking the RMD. But sometimes people don't need the money out of the IRA and they're stuck taking the RMD anyway. So this, you could actually take the money and drop it back into your Roth and just keep going.
Well, you got to convert it. That's the only way you can do it, where you avoid some of the other issues there, is you convert it to the Roth.
Well, you're paying the taxes either way.
Correct.
The issue is with Roth is you can only contribute what you earn. That's the only other problem.
Right. Yeah, and there's no limit on the conversion amount. There's no age limit, and you can do partial or total, like we talked about in terms of dealing with that. Yeah, I know we're getting up to 5:15 now, so I just want to
5:16 actually.
Last one, number 9. So this is the seed and tax break. This is the thing about that. Just what Craig was talking about. We're a little bit on it in terms of moving that taxable consequence around, because I'm just using Massachusetts here. Like Massachusetts, it's $1 million, Craig, right? The estate tax, the state
tax threshold is $1 million. Yep.
Right. So then there's a base that they'll take out, and then anything over that base, it's 12.8%. But if this money is in a qualified account, it's going to get hit with a very high tax rate. The highest tax rate right now is 37%. And of course, we're in the state of Massachusetts, so you're at 5.1%. So this just becomes taxes that become due on top of when somebody passes, right? And then, the best people to tax are the dead people because they don't vote. That's what happens here. So who do we want to hit with? That's who we want to take the money from. That's the way the government looks at it. The more we can get from the people who aren't going to vote and vote us out, that's what we're trying to take there.
Well, it's the other reason you see people who will move to states who don't have a state tax, such as Florida and a few others. Yeah. And a lot of the states are getting rid of that. They're kind of going with whatever the government rule is at this point.
Right, but again, that's all going to reset in 5 years. So then the states are going to sort of get thrown off. We were a percentage of federal, we weren't. What are we doing? How are we doing it? You're going to see all sorts of madness, right? So again, this is that, hey, the money whatever you have, whatever is yours, right? That's what's going to get taxed in terms of dealing with everything and what you're going to owe. And as this says, it could be up to 50% of any amount coming out of an IRA could get taxable. So you don't even talk about, the the Medicare tax or Obamacare tax, which adds another 4.7% if you're in a certain threshold, depending on the amount. Craig and I were dealing with a client, not, that we're still dealing with, right? That was literally going to walk into a distribution that was going to take 47% of the money. If you didn't, turn around and do certain things to stop that and stretch it in a way that's legal and allowed and lower that tax bracket down dramatically.
Which could have cost them tens of thousands of dollars.
Hundreds of thousands, actually.
Yeah, in additional tax money. Yep.
Right. All right. So in summary, right, the IRAs are a very, very valuable thing. We are absolutely believers. There's a lot of rules and, even new rules, as Craig mentioned, besides the Secure Act, you have the CARES Act, you got all sorts of craziness with the pandemic and COVID going on. But one of the fundamentals is I always treat it like this is the bucket that goes along with me, regardless of where I am, regardless of where I'm at. When I leave a job, if I have an IRA, I can pour my account over into that bucket and it comes with me. I don't have to worry about the employer. I don't have to worry about what was happening. It's a portable bucket that comes with me, which is really where the value comes into this. We say this every time we do these presentations. We're going to send out an evaluation form to everybody. Really appreciate you taking a moment just to fill it out, send it back to us. We value the feedback and input we get from everyone. It's important for us. We like to make sure that we're staying topical, we're staying on time, we're staying on point. This is Craig and I at some of our funner or better moments, depending on how you look at it in terms of what we do. And we had a lot of fun with our jerseys and some of the different things we do. What's on tap? What's coming up next week? We got an exciting one. We're going to be live at Your German Kitchen Cabinets and Design in Newton. They're a small business. We've got a sponsor for our Think with a Drink, that's Scout and Cellar Wines. And we're going to be talking to the two businesses about how they have adapted and changed during the pandemic. We'll talk a little bit about the PPP loan program and the CARES Act provisions, but we're really going to spend some time talking to them about some of the things that they've seen, some of the things they've done, and how it's impacted and affected their business. The 15th, we'll do financial literacy. That's just sort of trying to get back to basics with everyone. And then on the 22nd, we'll do money management tips. That's sort of what we got right now coming up for the next couple of weeks. Any questions out there? Craig, got anything on the board?
I have nothing. I think we're so thorough that no one had any questions.
Well, so you can reach us. It's info@aresfoundation.org if you ever have any questions. The direct line, 617-431-5045. But I certainly appreciate everybody being with us tonight, and I'm going to stop the program and say, have a great evening. Take care, everybody.